𝐿𝐎 Limited, a public limited entity, acquired 80% equity shareholding in Pepper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐎 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐎 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Public limited entity. Effectively, 𝐿𝐎 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for three companies, 𝐿𝐎, Pepper, and 𝐶𝐶𝑠. We have the statement of financial position for the three companies, that is 𝐿𝐎, Pepper, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. Come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐎 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Pepper, a public limited company, on 1st April 2024. So the company which is called 𝐿𝐎 Limited, this company acquired 80% equity shareholding in a company which is called Pepper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐎 is the parent and then Pepper is the subsidiary. You can see also we're given the date of acquisition. Then from there, I want us to go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐎 Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐎 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told, acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax and other comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of CSAT. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalue the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation under charge. depreciation other charge, and equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told LOC Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCH fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiary are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unreleased profit, and this unreleased profit is always by the selling company. The selling company is this one. So this is unreleased profit by Paper. So how do we compute this unreleased profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods will be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 over 5. So this one will be, the margin will be 1 over 5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1 this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the 3 adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which Lock Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in Caesar were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, you said we only compute the goodwill on acquisition of the subsidiary and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company that is paper, paper limited, and as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns. And our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2. of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in two forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, under the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and local limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331 and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1. Remember the formula here: 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically, what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically, what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI. Parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51.80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax? The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year added on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in Sisters, which is 50%. That gives us now the group share of Sisters Limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always have 3 mark. No single question for group accounts will come across whereby the distribution cost is to be adjusted. This is always a free mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting 13? Yes. So then below that, we have the administrative expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation added charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 14 what? 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. Will it come to 121? Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? this plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a 3 mark. Income tax expense. Income tax expense, also this one, is always a 3 mark. A 3 mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case we are done, and that what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE. And then this depreciation other charge of 70 will be deducted from the PPE. 2 adjustments here. 2 adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent and the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year, Sisters was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, we are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include here. Then from there we proceed and basically we record the current asset. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we said should be deducted from the group inventory. Inventory is part of this. So we less and there is profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total assets in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a part. These are some of the items you don't have to compute in an exam. They will consume a lot of your time and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. we have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to recall that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables, for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper, paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically you should do is to have 3 columns for our companies here, starting with the parent, which is log, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we're given the retained earnings of log, that 380. For paper, it is given as what? 1800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. What? Acquisition. That does not apply to the parent. It only applies to these 2 companies. Yes. And I think for this, what we will do, for this company, I think for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something you have already computed. Who can give me that figure? that retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is pre-acquisition. Is that the case? So pre-acquisition here need 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the scissors? Scissors, when was it acquired? I hope you can remember when scissors was acquired. Scissors was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year, 6 months to the end of the year. Basically, for scissors, we need to have, first of all, its retained earnings at the end. Its retained earnings at the end for scissors is 12, the value which we have here. Let's be together here. And then we also need to have the profit for scissors for the year. That one, we get it from the income statement. From the income statement, the profit for the year for scissors is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of scissors on this date of it was acquired? Just like how we computed this is quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of scissors at the start, which you have said is this, minus this, which will give us 560. And then for me to compute the retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and track variable, what do we get here? We get what? 5 what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. There are some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this and it is profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have and it is profit that will also be deducted from the retained earnings of paper 50, like that. Like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures. That is 380. This one 2400. This is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent we take 100. For paper we take 80. And for this company that is the sisters, we take 50. We take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38 what? 60. Basically, you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 3860, which basically will give us 9360. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now, to compute this, very simple. We take the NCI at fair value, and the NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share log the post that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary, which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we less here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No, it came to be a deducted there. So we add these two values and they give us 940. So the NCI fair value here is basically 940. But basically I'm saying if, although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this, because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. $10 bob. 10 bob is, where do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be, is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is the, what is the difference? Is the difference, is it 110? 110, yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted? So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 92, 70. And the retained earnings should be 30, 37, 50. Yes, it should now balance. It should now balance. It should now balance. Is it not balancing? Yes, it should balance. So I think that is what you have forgotten here, because remember, these are an expense which the parent company was supposed to have accounted for. It the parent company needed to recognize this as an expense, and that's why you can see in the income statement, the parent company didn't have a finance cost that was supposed to be captured here, and therefore even the profit which you have taken into account here, that was supposed to have been deducted, and because it was not deducted, that's why we're deducting it here. Sasa, yes. So basically, this is what was required as far as that question is concerned. And I'm saying this is one of the easiest questions which has ever been tested in advanced financial reporting in relation to the group account. In relation to the group what? Account. And there is a question which I'll give you there as an assignment. You attempt it. Because now what I want us to do once we meet in our next class, we are looking now on special cases in group accounts. We will start by looking on the aspect of piecemeal acquisition. We do a question, just a small discussion, and then we do a question. In our next class, that is what we will do. That is on Tuesday. Then on the Wednesday, we will be able to look on how we account for the disposal of interest. And then on Saturday, we do foreign subsidiaries. So basically, we should be done with this next week. What we will be remaining with is the group cash flow. Is the group what? Cash flow. So because we have those three concepts which are remaining: piecemeal acquisition, the disposal of interest, and the foreign subsidiary. We will be able to take one class each, but basically we will be able to come back and look on this during our revision. So the question I want you to attempt is the question for December. The question for December 2022, which basically is question number 3. Question number 3. I want you to attempt this one. Maybe during our revision, we will be able to look on it. We will be able to look on that. We will be able to look on this. We will be able to look on this. Remember, what we said is that if everything goes on well, we should be done at least with this by next week, our first class. And then from there, I think what will be remaining is maybe the theories and maybe like the financial statements of the insurance company. Right now, we can say that we are almost like over 85% done with the syllabus. So I'm hoping that if everything goes on well, we should be done with this by next week, but one on Tuesday. On what? Tuesday. So let's stop at that point for today. You have a nice weekend and make sure you attempt that particular question. In case you come across any challenge, you can maybe get some assistance from me. Equally, if you're able to attempt the question, you can send it to me. I'll be able to check on it and give you the feedback. Sasa, yes, we stop at that point. Have a nice weekend. See you next week on Tuesday. The topic is the presentation of financial statements. And basically what you're going to cover as far as this topic is concerned is how the listed companies prepare their financial statements at the end of the year. So, but maybe first of all, you can ask yourself, what are listed companies? Listed companies are basically those companies whose shares are trading in the securities exchange market. Like in Kenya, we have so many listed companies. We have a company like what? Safaricom is a listed company. Kenya Commercial Bank is a listed company. Equity Bank is a listed company. All these companies at the end of the year, they are required to prepare financial statements, which will be published. Published means that once those financial statements have been prepared, they will be made available to the shareholders, including the members of the public. That's why we refer to those financial statements as the published. They will be made available to the members of the public. Now, when the listed companies are preparing their financial statements, which are then to be published, those financial statements should be prepared in accordance with this particular standard here, International Accounting Standard number 1. And therefore, in this case, we can say IAS 1 basically prescribes how the listed companies should prepare the financial statements for publication purpose. And therefore, this particular standard 1, it basically prescribes what a complete set of the published financial statements should contain. And number 2, how should those particular financial statements be prepared? Maybe first of all, we can look on what is contained or what should be contained in a complete set of the published financial statements. Remember, you have said published financial statements and financial statements to be prepared by listed company for publication. Now we are saying a complete set of the published financial statement should comprise of the following component. The following component, 5 components. Number 1, we have the statement of a profit or loss. Number 2, we have the statement of a financial position, formerly known as the balance sheet. Number 3, we have the statement of changes in equity. The statement of changes in equity. Number 4, we have the statement of cash flows. Statement of cash flows, of which this statement of cash flows, this one we're going to do this as a separate topic. And basically in this case, we will be able to see that a statement of cash flows is prepared in accordance with a different standard which is International Accounting Standard number 7. Then number 5, we have the notes to the financial statement. The notes to the financial statement. So therefore, a complete set of the financial statement prepared by a listed company or by a listed company for publication purpose. Basically, we are saying should comprise of these 5 components. So I've said in this topic, we're going to look on how we prepare, we're going to look on 4 components. One, we're going to look on how we prepare. What is a statement of profit or loss? How do we prepare the same? A statement of financial position, how we prepare the same. A statement of changes in equity. This one we will do it as a separate topic, and also we will discuss something to do with what? To do with the note to the financial to do with the note to the financial statement. But basically, I want us maybe we start by discussing on what are the notes. What are the notes to the financial statement? Now, the notes to the financial statement, we can say that these are the supplementary notes. Supplementary notes, these are the notes which accompany the financial statements. Once a company has prepared the financial statement, those financial statements can be accompanied with some notes. So the main objective of those particular notes basically is to provide more information about some of the figures which are contained in those financial statements, and maybe also to provide certain information to the shareholders which is not captured in those financial statements. So therefore, these notes to the financial statement, we can say that these are supplementary notes. These are supplementary notes. Supplementary notes to what? To the financial statement. They basically supplement. They supplement the information which is contained here. They supplement the information which is contained here. They provide more information other than the information which is provided in this financial statement. So these notes basically contain information about what? Contain information about the accounting concepts. The accounting concept. The accounting concept which were used. The accounting concept used in preparation of the financial statements, and also the accounting policies. The accounting policies used by the company, not used rather, the accounting policies adopted by the company to be able to prepare the financial statement. So basically what we know is that when a company is preparing the financial statements are prepared using various accounting concepts. Good examples of the accounting concepts used in preparation of financial statement include something like the accrual concept, the prudence concept, the going concern concept, and so on. So therefore, in this particular note, the company will be providing information about the accounting concept which we were relied upon in preparation of those financial statements. Number 2, the company will also provide information about the accounting policies adopted in what? In preparation of this financial statement. When we talk about the accounting policies, we are talking of, for example, how the company is depreciating the asset. Is the company depreciating the asset using straight line or basically using the reducing balance method? So that information will be provided in this particular. That information will be provided in this particular notes. And also here, the company can also provide information about how the inventory was valued, because the company should determine the value of the inventory at the end of each year. So for those who are doing management accounting, for those who have done management accounting, you know, to determine the value of the company's closing inventory, there are various methods which can be used. We have RIFO, we have FIFO, and also we have the weighted average method. Now, in financial reporting, inventory should be valued using 2 methods, using weighted average method or RIFO. So the company in the notes will clearly explain which method was used to determine the value of the closing inventory. Is it weighted average method? Is it RIFO? So some of the information, therefore, which may be contained in these notes will include what? The basis of presentation the basis of presentation of financial statement. So basically, in this note, the company can provide information that the financial statements were prepared in accordance with the International Accounting Standard number 1 and also in accordance with the Companies Act. So that is the basis of preparing the financial statement. So also here, the company will provide information about depreciation of assets. How was the asset depreciated? Were they depreciated using straight line or the reducing balance method? The company may also include information about what? About contingent assets. Contingent asset, this refers to the probable assets or the asset which may or may not arise in the future, which may or may not arise in what? In the future. There is a topic we will be able to discuss more about this. I think at the IS, in the topic number 1, there is something we are going to discuss about this. So in the notes may also include information about the contingent liabilities. Contingent liabilities are probable liabilities. Liabilities which may or may not arise in what? In the future. So therefore, these are some of the items which may be included in these particular notes, which accompany the financial statements which have been prepared. Then let's come back to this one. Remember, I've said in this topic, we will not discuss this one. This one, we will do it as a separate topic. So then from there, what is a statement of a profit or loss? A statement of profit or loss, this one can also be known as the income statement. It can also be known as the statement of comprehensive incomes, statement of comprehensive income. So this one basically is prepared by a company to determine the financial performance of a company in a certain year. Meaning that a statement of profit or loss basically will be prepared to compare the incomes with the expenses. The difference between the incomes and expenses is automatically the profit for that year. Now, how do we prepare this income statement in accordance with the International Accounting Standard number 1? Or is there any difference in terms of how we prepare an income statement for publication purpose and how generally the income statement is prepared? Yes, there is a difference. When preparing an income statement for publication purpose here, in accordance with IAS 1, all the expenses of the company are basically classified under 5 categories. If you can be able to recall, for example, in financial accounting, in that unit of financial accounting you looked on how companies prepare their financial statement and you are preparing expenses separately. Salaries, depreciation, rent, you are recording those expenses separately. But in this case, we are saying in the preparation of this statement of profit or loss for publication purpose, we classify the expenses into how many categories? Into 5. The first category is something called the cost of sales. Cost of sales. So this cost of sales, is basically, or how do we compute the cost of sales? How do we compute this cost of sales? I hope you can be able to recall in the lower level, you are computing the cost of sales by taking what? By taking the opening inventory plus purchases minus the closing inventory. Is that what we do here? No. So in this case, we compute the cost of sales by taking the opening inventory of the company plus purchases minus the closing inventory. But in this case, we go further and include depreciation. Depreciation on PPE. Depreciation on PPE should be included here unless told otherwise. There are some instances whereby you can be told the depreciation on PPE, classify that as part of distribution or part of the administrative expenses. But if the question is silent, include that here. And then to this, we also include the loss on disposal. Loss on disposal, this whereby the company sold assets during the current year, but at a loss. So that is an expense, we add it here. But in case the company sold some asset at a gain or at a profit, so the gain basically we know is an income. So what we do is that that gain, we deduct it here because it's an income. So remember, cost of sales is an expense. So this gain should reduce the cost of sales because the gain is an income. So that's how we compute the cost of sales. The other category of expense is the administrative expenses. Administrative expenses. So these are expenses incurred by the company, or these are expenses which are incurred as a result of managing or running the affairs of the company. These are like the office-related expenses. And the expenses which are incurred as a result of managing the affairs of the company. They include things like the office rent, the office salaries, and so on. Then from there we have the distribution cost. Distribution cost, basically, this is a cost which is incurred by the company in selling goods and distributing goods to customers, like the advertising costs, the carriage outwards. So the transport cost incurred by the company in delivering the goods to the customer's premises. All those are distribution costs. And then from there, we have the finance cost. Finance costs, these are costs incurred by the company in raising finances. So these include things like the interest on loans, the interest on debentures, things like the preference, or actually the dividends on redeemable preference shares. This is basically very important. You must be able to remember this. In case you come across a question and you're told the preference shares issued by the company are redeemable. So redeemable preference shares are preference shares which have been issued by the company, and the company has an obligation to redeem, to buy them back after a given period of time. So this is just like a loan. We know a company borrow a loan, the company agrees with the bank, the loan has to be repaid back within a certain number of years. The same case, these shares are issued, the company agrees with the holders that they will be bought back, they will be redeemed by the company after a number of years. So this is a non-current liability to the company in the balance sheet or in the statement of financial position, and the dividend on these shares is classified as part of the finance cost. And then from there, we have the other expenses. So the other expenses basically refers to any other expense incurred by the company, but does not qualify to be classified under the above four categories. So therefore, in preparation of this statement of profit or loss, or basically an income statement or a statement of comprehensive income, we basically classify the expenses into what? Into 5. Then, also when preparing this statement of profit or loss for publication purpose, we only have a single column. Maybe in the lower level, you used to have like 2 columns here. In this case, we only have 1 column. And how do we prepare this? We start with the sales, but in most of these, at this level, you'll not be given the sales, but you'll be given something called the revenue. You'll not be given the sales, you'll be given the revenues. So and then to this, we less the cost of sales. Cost of sales, now you have to recall, how do we compute this? This is basically the computation of the cost of sales. You compute that, here you bring the final figure. And then we get the gross profit. So to this gross profit, we proceed and we add other incomes. So the other incomes of the company may include what? The other incomes of the company may include investment income. And basically this investment income should be deducted from that. Sorry, not deducted, sorry for that. Should be added, not deducted. This is an income, not expense. Okay, so then this may also include things like what? Things like revaluation gain on investment property, and the things like the revaluation gain on financial assets at fair value through profit and loss. This is basically something we came across in the topic of financial instrument. So those are basically some of the other incomes by the company. So basically after that, we proceed now and we less the other expenses. Remember, here we have already captured one expense. So the other expenses maybe you can just get the total incomes. We less now the expenses, which include the administrative expenses, the distribution cost, then the finance cost, and basically any other expense. And then we have the profit before tax. Now, to this profit before tax, we proceed and we less the income tax expense, And if you can be able to recall from our previous topic, this income tax expense basically comprises of two components of taxes. I hope you can be able to remember specifically what we did on Tuesday. This comprises of the current tax expense, which should be deducted from the figure up there, from this figure. And this one also comprises of the deferred tax expense stroke deferred tax income. So if we have a deferred tax expense, that one should be deducted from this profit. If we have a deferred tax income, that one should be added. And then what do we get? We get now the profit after tax. We get profit after tax. So the profit after tax, this one can also be known as the net income. It can also be known as the profit for the year. This is something you have to recall from what we did in the topic of ratios. We said profit after tax is the same with the net income, is the same with the profit for the year. And then out to this, we proceed and we add something known as the other comprehensive income. This is basically something I've explained in so many topics. I've explained what is the difference between other comprehensive incomes and other incomes. I said other incomes, these are incomes which should be part of the profit for the year. They should be part of this profit. They include all this. Other comprehensive incomes are those incomes by the company. They should not be included within the profit for the year. Now, what are good examples of these other comprehensive income? These include any revaluation gain on property, plant, and equipment, any revaluation gain on financial assets at fair value through other comprehensive incomes. Income. Remember also this same something we came across in the topic of financial instrument. Then from there, we basically proceed and we get the total comprehensive incomes. So this is how we prepare a statement of profit or loss, which we are also referring to as the income statement, also known as the statement of comprehensive income, basically for publication what? For publication purpose. Purpose. And you see, we have a difference in terms of how we are preparing this and how we used to do in financial accounting. Yes, you can see there is a difference because here you can see expenses majorly are classified into 5 categories. In other terms, we say that this statement of profit or loss, we prepare it in a condensed manner. We try to condense items. So we try to not to record most of the items of expenses and also incomes separately. We classify them under specific headings. So having this, then I want us to move and look on the is it the third? It should be the third one, because first of all, we have discussed on the notes. This one should be the second. So then from there, we have the statement of financial position. And no need to worry, I will be able to share the notes on this. So no need to worry. But we said whenever you're discussing this in class, maybe you can just be sketching something. Can just be sketching something, maybe for your understanding, but I'll be able to share the notes on this. Now, a statement of financial position, formerly known as a balance sheet. This is something we have come across in so many topics. In the topic of cooperative society, in the topic of financial statement of professional firms, financial statement of those entities involved in farming or agriculture activities. This is basically something you have come across in so many topics. Now, this one we know is prepared to ascertain the financial position of the company, financial position of a company at year end, or basically at the end of what? Of the year. At the end of the year. At the end of what? Of the year. At the end of the year. At the end of the year. At the end of the year. Is Morimu clear? Is Morimu clear from your side? Is Morimu clear from your side? Is Morimu's video clear from your side? Is Morimu clear from your side? Yes, Francis, check the internet from your side. Check the internet from your side. Okay. Statement of financial position. It is prepared to ascertain the financial position of a company at the end of the year. At the end of the year. Now, this one, basically, we know is prepared based on the accounting equation. The accounting equation states that assets are basically equal to equity. In case of a company, we talk of equity, not capital, plus what? Plus liabilities. Plus liabilities. Is there any difference? Is there any difference in terms of how we prepare this statement of financial position of a listed company and how we prepare the other statement of financial position? No much difference. No much difference. So in here, we start by basically recording assets. And what we know is that the asset must be classified into two, non-current assets and current assets. We get the total. We proceed and record equity. Equity, we know this comprises of ordinary share capital plus reserves. And then from there, we record liabilities, which include non-current liabilities and current liabilities. So no much difference in terms of how we prepare this one. So in fact, we will not be discussing on the format, because the format which is used here is what we have been doing in all other topics, in all other topics. So then from there, next, I want us to look on the last component. So I want us equally we do a question today. So number 4, we have a statement of changes in equity. Statement of changes in equity. In other terms, this can also be known as the statement of changes in net assets. Statement of changes in net assets. First of all, we can ask ourselves what is equity. So basically equity, this one is the share capital and reserves. Share capital and what? And reserves. Equity comprises of share capital and reserves. And therefore, this one, that is equity, this one is basically prepared to do what? To explain the movement in the various items of equity. So why did the various items of equity change during the current year? If, for example, the share capital of the company, the share capital of the company at the start was maybe 10 million, and at the end of the year, the share capital of the company increased to 20 million. Why was that? Why did the share capital increase? So you can only be able to know the cause of that increase from this statement of changes in equity. That's why we are saying that this one is prepared to explain the movement, to explain why the various items of equity changed during the current year. So how do we prepare this statement of changes in equity? So to prepare this one, basically, we should have various columns. Here, the first column is always the details column. The details column. That is the first column. And then we include columns equal to the various items of equity the company is having. So some of the common items of equity a company may have comprises of ordinary share capital. Ordinary share capital, that is one of the item of equity. The other one is the share premium. Share premium. I know this something you know from financial accounting, specifically financial statement of a company. Yes, can you give me another item of equity? I see whether you can be able to remember. So some of the items of equity, share capital and reserves. We already have share capital. We have share premium, which is a reserve, which is the other item of equity which a company may have. Or the other item of equity, yes, I'm told by Helen, is the retained earnings. The retained earnings, also known as the retained profit. The other one is what? 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 You can't remember those items of equity. The other one is revaluation reserves. Revaluation reserves. Revaluation reserves. We may also have something like the general reserves and so on. So, but basically these are the common items of equity. Share premium, ordinary share capital, share premium, retained earnings, revaluation reserve, general reserve, and the total column there. So basically this should be the last column, the total column. So what do we start with here? We always start with the opening balances. The balance brought down. The balance brought down, this is basically the balance at the start of the year. So we record those balances here, those balances there, and then we get the total, we take it to the last column. And then from there, we have some adjustments for the transaction which occurred during the current year. But the first adjustment which we make here is something called the prior year adjustments. Prior year adjustment. So when we talk about the prior year adjustment, this is maybe an error which was committed in the previous year and which was supposed to affect the profit of the previous year, but that error was not corrected. So that error you come and you correct it to this opening or to this retained earnings at the start of the year. So that error, basically it always depends with the type of error. It can be either be added or basically be what? Deducted. For example, in this case, you may be told in the previous year, there was some bad debts which were written off, but they were not accounted for. So it basically means that those bad debts which were written off in the previous year, which were never accounted for, they were supposed to have been treated as an expense. And because they were not accounted for, this profit for the previous year was overstated. Because if an expense was not accounted for, the profit which was reported in that year was overstated. So you less it here. So then you take that to the last column. Okay. So this one should be dash like that. So then the other adjustment which we may capture here is basically issue of shares. Issue of shares. Maybe there are shares which were issued for cash. Mostly that will affect the ordinary share capital and the share premium. Another one is a right issue. A right issue, this where the company issues shares to the existing shareholders of the company, but at a price below the market price. Equally, that affects the share capital and the share premium. We take that to the last column. The other transaction we may take into account here is a bonus issue. A bonus issue is basically where the company issues shares free of charge. Usually that this one increases the share capital. And then once the company has issued shares free of charge, it is for the company to pay for these shares. The company pay for these shares using one of the reserves. The reserve which may be used by the company include either the share premium or the retained earnings. You'll always be told if the company made a bonus issue, which reserve was used? Is it the share premium or is it the retained earnings? The company can either use one of those two. And basically what happened is that in case of a bonus issue, the share capital of the company increases and then the reserve which was used to finance, to pay for those shares will reduce. That's why you can see we are deducting here. We are deducting the reserve which was used and then transferring it to the share capital. So then what else do we capture here? Is profit after tax. The profit after tax from the income statement, we take it to this column for retained earnings and then equal it to the total column. So the other item which we also capture here are the interim dividends. Interim dividends. So interim dividends, these are the dividends which were paid by the company in course of the year. So those dividends are always paid from the profit. That's why you can see we are raising that there. The other item which we may also have here is transfer to general reserves. Transfer to general reserves. You may be told the directors proposed to transfer a certain amount from the retained earnings to what? To general reserves there. To general reserves. And finally, the other item we may have here is a revaluation gain or a revaluation loss. In this case, you can be told some items of PPE were revalued upward or downward. So if there was a revaluation gain, we bring it in this column known as the revaluation reserve as a positive. If there was a revaluation loss, we still bring it here, but as a negative. And then we take that now to the last word, to the last column. Yes, so basically those are some of the items which we may capture here. And basically then from there we get what? We get the balances at the end of the year. The balances at the end of what? Of the year. So these balances at the end of the year, this one we transfer them to the statement of financial position. These ones are transferred to statement of financial position, specifically under equity. Specifically under what? Under equity. Under equity. So therefore, this is basically how we prepare the statement of changes in what? In net asset, or basically the statement of changes in what? In equity. In what? In equity. So basically that's what you need to know as far as the preparation of the public financial statements are concerned. Maybe something you need to remember, something else you need to remember. I'll be able to explain that in course of doing our question, in course of doing our question. Sasa, in course of doing our question. Now, I want us to take a small breather because I want us to come back and basically we look on a question. We must finish on a question today, but we will start with a question which is not that demanding. Basically, we start with a small question. So, and I want us to start with a question. I think we were able to. There is a question which we did part of it, December 2021. That is a question I want us to start with. That is a question I want us to start with after the break. And I think this was question number 5, if I'm not wrong. There is a question we did something to do with the deferred tax and the current tax. I think it was a question for Bawabu Limited. Was it for Bawabu? The question we tackled in our previous session in relation to, was it deferred taxes? Deferred taxes. I think it should be that one. Should be that one. So let's take a short break or a small breather, basically, for 5 minutes. For 5 minutes, we come back. As we come back, make sure you have that question with you. That is a question I want us to do. I want us to do after the break. Sasa, yes. So see you after that short break of just 5 minutes. 5 minutes. Question here. I hope you already have it with you. Do you have this question with you? If yes, please confirm. If yes, please confirm so that we can start. Do you have this question with you for December 2021? If yes, please confirm so that we can start. Okay. So what are we told here? What are we told? So what are we told? This is question number 5, and the question is: the following trial balance relates to 𝐉𝐎𝐈𝐍 Limited as at 31st of December, March 2021. So we're given a trial balance there. And the first item we're given is the ordinary share capital, the share premium, the retained earnings, property at cost. And then we have the plant and equipment accumulated depreciation on 1st April 2020 for buildings, plant and equipment, inventory as at 31st of March 2021, trade receivables, bank overdraft, deferred tax, trade payables, current tax, revenue, cost of sales, distribution cost, administrative expenses, dividends paid, bank interest. Then we have some additional information, number 1 all the way to note number 4. And then from there, what are we required to do here? We are required in Roman 1 or part A, we prepare the statement of profit or loss for the year which ended 31st of March 2021. And part B, we are required to prepare the statement of financial position as at 31st of March 2021. So we are going to start with the basically Roman 1, but even before we prepare what is required, it is important for us to go through the additional information, number 1, all the way to note number 4. We see, are there some workings which are required? If there are some workings which are required, that's basically what we are going to start with here. So in note number 1, what are we told? We are told that on 1st of April 2020, it is important for you to note that 1st April of 2020 is the start of the current year. If you go to the requirement, you'll be able to see that we are required to prepare financial statements on 31st of March 2021. This is when the year ended. So this year started then when? On 1st of April 2020. That is the start of the year. This is basically the end of the year. So what we are told in note number 1 is that on 1st of April 2020, which is the start of the year, the directors of 𝐉𝐴 Limited resolved that the financial statement would show an improved position if the property was revalued to market value. At that date, an independent valuer valued land at shillings 160 million and building at shillings 485 million. The remaining life of the building, as at that date, was 25 years. And then you're told 𝐉𝐴 Limited does not make any transfer to the retained earnings for excess depreciation. In that case, we are told to ignore the deferred tax on the revaluation surplus. So as far as that point is concerned, point number 1, we are told the company revalued 2 assets: revalued land, revalued building. Anytime the company value assets, we need to determine, was there a revaluation gain or a revaluation loss? That is the first thing we need to do here, and that would be our working number 1, whereby we need to determine the revaluation gain or basically loss on the property. Remember, the asset which was revalued here is the property. And actually, there is something I mentioned, I don't know whether in our previous class, whereby I say that if you're given property usually comprises of 2 assets. Property usually comprises of 2 assets. Property comprises of buildings and also land. If you come across this usually comprises of 2 assets. So how do we compute the revaluation gain or loss for these 2 assets? So we will compute the revaluation gain or loss for buildings and also for land. So to compute this revaluation gain or loss, we compare 2 values. We compare the revalued amount. Our assets were revalued at how much? And then we compare this with the net book value. In case an asset is being depreciated, if an asset is not being depreciated, we compare that with what? With the cost. Like generally what we know is that we don't depreciate land. So therefore, in computing the revaluation gain or loss for land, we will compare the cost with the revalued amount. But for buildings, mostly these ones are being depreciated. So we compare the revalued amount with the net book value. So let's first of all we have the revalued amount, because the revalued amount, we have them in addition information number 1, sentence 2. At this date, an independent valuer valued land at shillings 160 million. So this one was revalued to 160 million. Whereas buildings were revalued to 485 million. 485 million. So then what we need to do is we go back to the trial balance. In relation to all for land, we need to determine what is the cost for land, because we know land is not depreciable asset. And then for building, we need to determine what is the net book value at the start. So let's go back to the trial balance, specifically where we have property. Property is the fourth item in the trial balance. From the top up there, we have property. And basically, you're told that this property, we are given the value as what? 732. And also, in this case, for us to be consistent, let's work with these figures in thousands of shillings, like this. We work with all our figures in thousands of shillings for us to be consistent. So mean that RAD here, RAD was revalued to 160 million, which in thousands of shillings will be 160,000. This one was revalued to 485 million, like that, in thousands of shillings. So for the property which is in the trial balance, this is the property. We are told property comprises of land, of RAD. And basically, I hope you can see we are told that the cost of RAD is 146 million. 146 million. So meaning that the difference here will be the cost of buildings. So what is the cost of buildings? This minus 146. We try to hurry up because this question we must finish. We must finish this question here. Yes, I'm told by Helen that this one will be 586,000. So that is the cost of buildings. Now, in this case, still, if you take just below the property, we have plant and equipment, and below that, we have accumulated depreciation. So we're given the accumulated depreciation for buildings. So you can see these buildings are being depreciated. So I've said in computing this revaluation gain or loss, we will compare the net book value of the building, this one, with the revalued amount. But for land, we'll compare this revalued amount with the cost. So the cost of building, sorry, the cost of land is 146. We don't depreciate what? We don't depreciate land. So what will be the net book value? The net book value, because whatever you have here is the cost. The net book value of an asset we know is equal to the cost minus accumulated depreciation. So the cost of building is what we have here, 586,000, minus the accumulated depreciation in the trial balance. So what is the accumulated depreciation for buildings within the trial balance? I hope you can see that below plant and equipment, which is 122,000. So this will give us what? A net book value of what? A net book value of what? This will give us a net book value of 484,000. 484,000. Is that what you're getting? 484,000. And please let participate in class. Mwalimu need to get the answers here. Let's please participate in class. Once you get the answer, type it in the chat box. I need to see you participating in class. I need to see you participating in class. Once you get the answer, type it in the chat box. Type it in the chat box. Yes, that will give us 464,000. 464,000. So having this, then we can be able to move and we determine, do we have a revaluation gain or loss? Remember, in this case, for you to determine whether you have a revaluation gain or loss, basically you need to compare these two values. And if the revalued amount, this one is more than the cost of the net book value, we have a revaluation gain. If the revalued amount is less than the cost of the net book value, that is the revaluation. That is the revaluation loss. Basically, I've said if this is more, is the revaluation gain. If this is less than this, is the revaluation loss. And I hope you can see this is more than this. Equally, this one is more than this. So it means that here we have a revaluation gain. So what is the revaluation gain here for land? Because the cost of land was 146, but land was revalued upward to 160 million. So you have 14 million. 14 million. What about buildings? Buildings had a net book value of 464, they were revalued upward to 485. We have a revaluation gain of how much? Of 21. Now, this revaluation gain, when preparing our statement of profit or loss, as recorded in Roman 1, this one will be captured there as part of OCI, OCI in full, and the other comprehensive income. And the other comprehensive income. And still, when preparing the statement of changes in equity, this revaluation gain will be taken to the corner for the revaluation reserve. Then still in note number 1, there is something else we also need to compute. I hope you can see in sentence number 3, we are told the remaining life of the building is at that date. At the date the building was revalued was 25 years. So why are we given the remaining useful life of the building? That is given to help us in terms of computing the depreciation per annum of what? Of the buildings. It is important for you to note that once the asset has been revalued, in computing the subsequent depreciation, we use the revalued amount. In computing the subsequent depreciation, we use what? We use the revalued amount. So we will compute the depreciation for this building for the current year using the revalued amount. The revalued amount is this one, 485. And once we are given the remaining useful life, we divide this with the remaining useful life. The remaining useful life of the building are 25 years. 25 years. 25 years. So this will give us what? This will give us depreciation per annum of how much? Juliet is saying my board is not clear. Is that the position? Is that the position? Is my video okay from your side? Is Morimu's video okay from your side? Yes, but I think it is improving slowly. It is improving slowly. So therefore, what I've said is that we are given this remaining useful life for us to be able to compute the depreciation on buildings. So the depreciation on buildings, I think I've seen that figure being 19,400. And this one, unless told otherwise, we have said should be included within the cost of sales. Within the cost of sales, unless told otherwise. So that's basically what we are required. Let's move to note number 2. We are told that depreciation, our plant and equipment is depreciated at the rate of 15% per annum using the reducing balance method. All depreciation is charged to the cost of sales, and none has been charged on any non-current asset for the year which ended 31st of March 2021. So what we need to do is we compute the depreciation. In note 2, we compute depreciation on plant and equipment. Plant and equipment. And basically the depreciation on plant and equipment, this one will be equal to what? This one will be equal to 15%. So which method is being used by the company? The reducing balance. You have to recall, under the reducing balance, we compute depreciation based on the net book value, based on the net book value, based on the net book value. So the net book value here will be equal to the cost. That's basically what you have said here. The net book value is equal to the cost minus the accumulated what? Depreciation. So therefore, we take the cost of our plant and equipment in the trial balance, which is basically below the plant, which is 427,000, minus the accumulated depreciation, which is 85,400. So we get, first of all, the difference here. Then we compute. We compute what? We compute 15% of that. So what are you getting here? 427 minus 85,400 times 15%. Yes, what are you getting? What are you getting? What are you getting? What are you getting here? What are you getting? Zipporah, what are you getting? What are you getting? What are you getting here? Yes. So 51 to 40, and also record what you're told. All the depreciations should be included as part of the cost of sales. And actually, depreciation for the current year was not yet computed. I think my video now is clear. Is that the case, Helen? Is my video clear now from your side? I can see it has improved. It has improved. Okay, so then we move to note number 3. Remember, in our previous class, we did something in addition to note number 3. So we'll be able to move that a little bit fast. We are told 𝐉𝐎𝐈𝐍 Limited estimated that income tax provision of shillings 113.8 million is required for the year which ended 31st of March 2021. So meaning that during the current year, the estimated tax liability, the estimated tax to be paid during the current year is 113.8. And then you're told in paragraph 2, the balance on the current tax in the trial balance represent other stroke over provision of the tax liability for the year which ended 31st of March 2020. So if you can be able to recall, in the trial balance, we have something called the current tax. Can we go back to the trial balance? You tell me how much is that current tax? And the current tax in the trial balance, recall very fast what we did in this question, what we did in relation to that note. The current tax in the trial balance, how much is that? That is basically a figure of 12,800. Now, what you are told in note number 3, specifically sentence number 2, this amount is over or under provision of current tax in the previous year. Over or under provision of current tax in the previous year. Remember, you said the examiner, if in the previous year there was over or under provision, the examiner will not specifically tell you whether it was over or under. It's upon you to be able to recall. And actually, we said you need to check whether this balance in the trial balance is a debit balance or a credit balance. So we said if this is a credit balance, it appears on the credit side, it is automatically over provision. If it is on the debit side, it is under provision. And therefore, take into account this particular balance is on the credit side of the trial balance, we say that this one is over what? Over provision of the current tax in the previous year. So this over provision of current tax in the previous year, we said it should be brought forward to the current financial year and be deducted from the estimated tax liability. So therefore, because in paragraph 1 of note number 3, we are told that 𝐉𝐴 Limited estimated that income tax provision for current year is 113.8. So the company estimated during the current year, it was supposed to pay tax of 113.8. So therefore, to compute the current tax which will be charged or which will be taken to the income statement, we said we take the estimated tax liability for the current year, this one, and then we less the over provision from the previous year, this one, which is we less, this one will be equal to 113,800 minus this 12,800. So this will give us 101,000. So this is the current tax which will be taken to the income statement, That's estimated tax liability minus the over provision. Then let's move to the last paragraph of note 3. And we are told that as at 31st of March 2021, that is the end of the current year, the tax base of 𝐉𝐴 Limited net asset was 292 million less than the carrying amount. The income tax rate is 30%. So that 292, we said is the difference between carrying amount and net asset. That is carrying amount and tax base of the company's net asset. In other terms, this is the temporary difference. This is the temporary what? A difference. And specifically what you are told is that the tax base of the net asset of this company was less than carrying amount with an amount of 292 million. So remember what we said in our previous class. We said we have two types of temporary difference. The taxable temporary difference and deductible temporary difference. We said a temporary difference is taxable whereby the carrying amount exceeds tax base. And a temporary difference is deductible whereby the carrying amount is less than tax base. And we say this one, taxable temporary difference, result to something called deferred tax liability. This one result to something called the deferred tax asset. This what you just need to recall from what we discussed in our previous class. So what we need to do is to determine whether this temporary difference is it taxable or is it deductible. And because we have the word tax base before, we can start with the carrying amount, and then we said we will change this inequality sign from less than to greater than a tax base. So mean that the carrying amount is greater than tax base with the 292,000, which automatically means that this is a taxable temporary difference. This is a taxable temporary difference. So if it is a taxable temporary difference, we need to compute something called a deferred tax liability at the end of the year. So the deferred tax liability at the end of the year will be equal to the taxable temporary difference, this one, times what? Times the tax rate. Times the tax rate. And the taxable temporary difference is 292,000 times the tax rate, which is given in note number 3, the last sentence, 30%. 30%. So this will give us what? And I think we computed all these figures. This was coming to a figure of, was it 90 what? 87. 87,600. 87,600. So having this, then we said, because these are deferred tax liability at the end of the year, we need to compare that with the deferred tax liability at the start. The deferred tax liability at the start of the year is basically what we have within the trial balance. If you go to the trial balance, you'll be able to see we have a deferred tax what? A deferred tax liability. So we have the deferred tax liability at the start, which is in the trial balance. And then we have the deferred tax liability at the end of the year, which we have computed here. The one which we have computed here is 87,600. And the deferred tax liability which we have in the trial balance is how much? Can you see the deferred tax liability in the trial balance? Who can see that figure? Who can see that figure? Yes, that figure I'm given by Helen as is it Helen or Zipporah? By Zipporah as 97,600. So we said compare the deferred tax liability and the deferred tax liability at the start and also at the end, and then you determine, do we have an increase or a decrease? So this basically is what? Is a decrease. Is a decrease. So we have a decrease in deferred tax liability. And actually we said a decrease. This one is a deferred tax income. In preparing our income statement, that is a deferred tax income of how much? Of 10,000. So that is basically what we are going to account for in the income statement. So let's move to the last note. Note number 4. We are told Babu Limited made 145 bonus issue on 31st of March 2021, which has not yet been recorded in the books of account. The company intends to utilize the share premium as far as possible to provide for the bonus issue. So we are told in that case, the company made a bonus issue. What is a bonus issue? A bonus issue basically, this is where the issue shares free of charge to the existing shareholders. So we have said that once the company make a bonus issue, these shares will have to be paid for by the company using one of the reserves. So therefore, we are told that the company made 145. In other terms, what that means is that during the bonus issue, the company was to issue one share for 5 shares which were held. That is the interpretation of that, 145. The company was to issue one share for every 5 shares which were held. Now, what we need to do here is we determine how many shares were held before the bonus issue, because we are told the bonus issue was not accounted for. To determine the shares which were held before the bonus issue, we go back to the trial balance, the first item, where we are given the share capital, we need to compute how many shares had been issued by the company before the bonus issue. We will take the share capital, which is 560. We divide that with the par value per share. I hope you can see still in the trial balance, the first item, inside the bracket, you're given the par value, which is 10 bob. So meaning the shares issued by this company are 56,000. So these are the shares which were held. So for us to determine the shares issued during the bonus issue, we cross multiply, then we divide. So we have 1 times 56,000 divided that with 5. This will give us how many shares? This will give us how many shares? This will give us 11,200 shares. It is also important to know that anytime the company is issuing shares during a bonus issue, shares are issued at their par value. So therefore, the shares issued during during this bonus issue, they had a value of 112,000. So this 112,001 will increase the ordinary share capital. The ordinary share capital of the company will increase. When preparing the statement of changes in equity, this one we added to the share capital. And then because the company utilized the share premium, the company paid for these shares using the share premium. The share premium will reduce with 112,000. And I think now having those workings, we can proceed and prepare what is required. We will start with part A. We start with part A, whereby we are required to prepare the statement of profit or loss of this company. The name of the company is 𝐉𝐎𝐈𝐍 Limited. And this is what? This is a statement of profit or loss. This is a statement of profit or loss, basically which is for the year which ended 31st of March 2021. 31st of March 2021. Now, remember, we have said that in preparation of this, we have a single column here. In this case, we don't use 2 or 3 columns. We just have a single column, just one column. So, and then here, now, for you to be able to prepare this, you must record the format which I've given you. We have said here we start with this, with the revenue. In very rare cases, this can be known as sales, but at this level, the examiner will give you what? The examiner will give you what? The revenue. One share is 10 shillings. The value is in 1,000. The share will not be divided by. Remember, Virginia, here, for you to be consistent, all our figures are in 1,000 of shillings. In 1,000 of shillings means that in any of the figure we have here, we have omitted the last 3 zeros. That's basically what you have to do for you to be consistent. Yes, for you to be consistent. This figure, we have omitted the last 3 zeros. Here we have omitted the last 3 zeros. The actual number of shares are not 56,000. They should be 56 million. Are we together, Virginia? Yes. All the figures here, because we want to be consistent. We don't want some figures to be in full, some figures to be in thousands, and some figures to be in millions. That's why even here we didn't work with the millions, we worked with thousands. So for us to be consistent. Okay, so where do we have the revenue? The revenue, we have it in the trial balance. And then we say there is a very important acronym, which I gave you in our previous class. We say this acronym is very important, especially in these topics. The acronym of DIRA. We say this one stands for drawings. We say companies may not have drawings, but this one stands for expenses. This one stands for expenses. This one stands for assets. We say these 2 items in the trial balance, they have a debit balance. If you're looking for asset or expense, you get it on the debit side of the trial balance. This one stands for liabilities. This one stands for equity. This one stands for revenue, or basically incomes. And we said all these items, they have a credit balance. We know revenue is an income. So when checking for income, you check it on the credit side of the trial balance. So the revenue, and basically that one do not have any adjustment. This one is a figure of 27, 79, 160. So to this, then what do? We less the cost of sales. Now the cost of sales, this one is given within the trial balance, just below that, just below this revenue, and it is given as a figure of 2,006,900. But basically, we know there is some adjustment to be made to that cost of sales simply because this depreciation on buildings, this depreciation should be added to the cost of sales. So we will make that adjustment here within the bracket. 2006, 900, and then we add this to depreciation, 19,400, and this other one for plant and equipment, 51,240. We get the final figure. We take it now to the last column there as a deduction. So this will give us what? So we have 2006, 900 plus we have 19,400 plus 51,240. So that will give us a final figure here of 2,077,540. So we less that from our revenue. So our revenue is 2,779,160, and basically we get what? We get the gross profit. We get the gross profit. So how much is the gross profit? 701 what? 620. Yes, I hope that is what you're getting. So then to this, we have said we proceed and we add other incomes. We add other what? Income. So basically, in this case, when checking for other incomes, we should go back to the trial balance. And basically, in this case, we have said all incomes, including revenue, they have a credit balance. So check the items appearing in the last column of the trial balance, whether you have any other income. So we check the items on the credit side. Up there, you can see we have ordinary share, capital share, premium, retained earnings. All those that we know are items of equity. And then down there, I'm only checking the items in the last column here. Down there, I can see accumulated depreciation for buildings, plant, and equipment. Those are not incomes. Down there, I can see we have bank overdraft, deferred tax, payable, current tax, revenue. So it basically means that in the trial balance, we don't have any other income. So we proceed and we get the total, which remain the same, total incomes. So these are total incomes. Total income. So to this then, recall we have said we proceed and we less the expenses. So for the expenses here, we have like four. The distribution, admin, finance cost, and other expenses. Another word, expenses, and other expenses. So let's go to where we have this cost of sales. Below the cost of sales, within the trial balance, I can see we have the distribution cost, and distribution cost is for the workings which you have done here. This expense do not have any adjustment, no adjustment to be made here. So we use the figure given in the trial balance, 164,700. So then below that, we have the administrative expenses. The administrative expenses equal this one will not be having any adjustment. So and that is 201,300. No adjustment here. So below that, we have dividends. Dividends basically is not an expense. This will go to the statement of changes in equity. Then below that, I can see bank interest. Bank interest, this is the interest charged by the bank, maybe as a result of overdraft, as a result of loans. So that is part of the finance cost. So we don't include it here as a bank interest, but we include it here as part of the finance cost. So the finance cost in our case will be 10,980. Then we need to check whether we have any other expense. Any other expense. Remember, you have said in other expenses. These are the other costs of the company, the other expenses of the company, which do not qualify to be classified as part of cost of sales, distribution, admin, or finance. And actually, we have said when checking for the expenses within the trial balance, we check the items appearing on the debit column. Can we go back to the trial balance? Specifically on the debit column, we see, do we have any other expense? Up there, you can see we have a property, plant, those are assets. Down there, you can see we have inventory receivables, those are assets. And then down there, we have cost of sales, distribution, admin, dividend, interest. So we don't have any other expense. And equally, if you check on what we have here, I think you have dealt with this. You have dealt with this. So these taxes, the current and deferred will be deducted from the profit after tax. So mean that in our case, we don't have any other expense. So what we need to do is basically we get the profit. We get the profit before tax. We get the profit before tax. So let's get this profit before tax here. The profit before tax. So it will be 701,620, this one, minus the 3 expenses. What are you getting here? Who is able to compute that figure? Who has computed that figure? Who has computed that figure? Yes, I'm given by Zipporah. 326 to what? 324, sorry. 324, 6 what? 640. So having that then, I've also received the same from Juliet. Okay. Yes, so having computed that, we need to proceed and we left the income tax expense. Income tax expense. Income tax expense. Remember, you say that this income tax expense basically comprises of 2 components of tax. This one is the current tax which is here, and the deferred tax. So here we will have number 1, the current tax expense. The current tax expense is what we computed here of 101,000. We less it from this, and then we have this one, deferred tax income. So the deferred tax income, because this is an income, this one we added to the profit. The amount of 10,000. The amount of 10,000, this one will be added to the profit, not to be deducted because it's an income. It's supposed to be added. But if it was a deferred tax expense, we less it. And then we get the profit for the year. We get the profit for the year. The profit for the year. So we check 324,640 minus 101 plus 10,000. I'm getting what? 233,640. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes, that is confirmed by Felix. Confirmed by Felix. Yes. So then we have said after getting this, we proceed and we add other comprehensive incomes. We basically proceed and we add other comprehensive income. So the other comprehensive incomes, we said that we have 2. We have this revaluation gain on land and buildings. So we have the revaluation gain on buildings and also what? Land. So the revaluation gain on buildings is 21,000. For land is what? Is 14,000. Then we get the total comprehensive incomes. We get the total comprehensive incomes. The total comprehensive incomes. You can see that far end. Sorry for that. Okay, you should be able to see that far end now. Okay, so then we get now the total amount there plus the 35,000, which will give us 268,640. 268,640. 640. Yes. So that is it. Are you getting that? If you're getting that, just confirm. Are you getting the same? Yes, that is confirmed. Now, I want us to move to, to the last part. But before we do that, I want us to prepare the statement of changes in equity, though it's not a requirement in this question. So the figures we are going to get here, we will use them in preparation of the statement of financial position. So let's prepare this one, though it was not a requirement of the question. So remember, you have said this one, we prepare it to show, or basically to adjust the items of equity. So here we start with the details column, and then which items of equity do we have in our question here? We will start with the first item in our trial balance, which is the ordinary share capital. So below that we have share premium. Below that we have share premium. Below that we have the retained earnings. The retained earnings. Those are the 3 items of equity. And I think in the trial balance we don't have any other, because we don't have general reserves, we don't have the revaluation reserve. But basically, from the workings which you have done here, we know that during the current year or at the start, the company revalued land and buildings. So this revaluation gain will be taken to something called the revaluation reserve. The revaluation reserve account. Then we have the total column. The total column. So then what do we start with? We start with the opening balances, and we must also indicate our figures will be 1,000 of shillings here. So we will start with the opening balances, and basically the opening balances are the figures we have in the trial balance. So the ordinary share capital is 560,000. Share premium 160,000. I'm taking the figures we have in the trial balance. The retained earnings is 241, 560. And then in that case, we didn't have the revaluation reserve at the start. Then we get the totals, we take them to the last column. We have 560 plus 160 plus 241, 560, which will give us 961, 5 what? 560. I hope that is what you're getting. Then to this, now what we need to do, we need to take into account the various transactions which occurred during the current year and which affected these items of equity. I think we can start with what we have here. Working 1, we have the revaluation gain, and this one we split it. The valuation gain on buildings, and the revaluation gain on land. This one will be taken to the revaluation reserve column. This column here. This column here. Land was revalued upward with an amount of 21. That is, buildings were revalued upward with 21, and land was revalued upward with 14,000. So then from there, what else do we have? Do we capture here? This will not affect that, but we have this bonus issue. Bonus issue. So the bonus issue we have said will affect 2 items. The ordinary share capital will increase with 112,000, whereas share premium we reduce with the same amount of money. So that will not affect any other column. And equally, if you take this plus that, it will give us 0. No amount will be taken to the total column, but for these 2 items, that will go to the last column, the total column. The same case with this 14,000. The same case with that 14,000. So then from this statement of profit or loss, what do we capture here? The profit after tax. Profit after tax, this one, or the profit for there. This profit after tax goes to the retained earnings column, this one. 233, 640, and then we take it to the last column, 233, 6 what? 640, 640 like that. Then There is something else we need to capture here from the trial balance. And I hope you can remember the second item from the bottom of the trial balance. We have dividends which were paid. We say dividends are paid from the profit. So the dividends which were paid, this one will be deducted in this column for the retained earnings. Dividends paid were 24,400. 24,400. Yes, so, and basically that also go to the last column, 24,400. So I think in our case, we are basically done. So what we need to do here is we get the balances. We get the balances at the end of the year. And these balances at the end of the year, we then transfer them to the statement of financial position. We transfer them to the statement of financial position. So we can start with the ordinary share capital, which will be 560 plus 112. And that will give us 672,000. 72,000. What about the share premium? We have 160 minus 112, which will give us 48,000. What about the retained earnings? The retained earnings column, we have 241, 560, plus the profit after tax, 233, 640, minus the dividends which were paid, 24,400, which will give us 450, 800. So what about the revaluation reserve? Here we have 35,000. 35,000. What about the total column? The total column, we have 961, 560, plus 35,000, plus 233, 640, minus this one is a deduction, is a negative, is a deduction, minus 24,400. So this will give us 1,205,800. 205,800. Is that what you're getting? 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 Do we prepare this? Do we finish this question? It will take us like the next 10 minutes. Yes, let's just finish, because I can see we have 7 minutes which are remaining. So let's finish. Let's finish. I want us now, we proceed, prepare the statement of financial position. Let's finish. Let's finish. Let's finish. So we go to part B. I think it's only one item which will be involving, because most of the items we have computed them. It's just a matter of posting them. So part B, the statement of financial position. So this is as at 31st of March 2021. So remember, we prepare this one based on the accounting equation. We always start by recording assets, which we classify into two, non-current and current. Also here, we need to have a single column, and basically the figures are in thousands of shillings. So what do we start with? We start by recording the non-current assets. The non-current assets. Now, for the non-current assets, I hope you can remember you have two. Which non-current asset? Can you remember the two non-current assets we have? Yes, we have property, which comprises of land and buildings, and also we have a plant and equipment. Is that the case? We have two. Now, in preparing a statement of financial position for publication purpose, all tangible non-current assets, because those are two tangible non-current assets, we don't record them here separately, but rather what we do, we compute their net book value at the end of the year, and we record a single figure here under the name of the property, plant, and equipment. So property, plant, and equipment basically comprises of all tangible non-current assets. So therefore, those tangible non-current assets We don't record them here separately. If you record them separately, in these questions, you lose the marks. You have to compute the total net book value of all tangible and current assets. You record them here as a single item called the property, plant, and equipment. So basically, I've said these include all tangible and current assets. I will start with the land and buildings. So buildings, or let me start with land. So maybe up there we can say this land. So basically we know land was revalued at an amount of 160. So is land being depreciated? No. The value for land remains the same at the end of the year. So then to this we add buildings. Buildings was revalued. Remember, anytime an asset has been revalued, you ignore the previous values of the asset, the previous cost, the previous accumulated depreciation. Now you work with the new value. The new value for the building is this one, 485. But now we know this was the value at the start. If it was the value at the start, and there was a depreciation of this amount, so what will be the net book value for buildings at the end? It will be equal to the revalued amount at the start minus the depreciation for the current year only. We have to ignore the previous depreciations. So the depreciation given in the trial balance, we ignore it anytime an asset is revalued. Sasa, yes. This is the new value. Then you only less depreciation for the current year. That is for buildings. And then to this, which other tangible and current asset do we have? It is plant and equipment. Plant and equipment, we will take the cost given in the trial balance, which is 427,000. Then to this, what do? We less the accumulated depreciation at the start, which is within the trial balance. The accumulated depreciation at the start for plant and equipment is 50, 85, 400. And then to this, we also less the depreciation for the current year, which is 51, 240. That is basically how we compute the net book value of an asset at the end. The cost at the start minus accumulated depreciation at the start minus the depreciation for the current year. So whatever you get here will be the net book value for all tangible and current assets. Can you give me the final figure here? So we start with the buildings. So we have 485 minus 19.4 plus 427 minus 85.4 minus 51.24 plus 160. Is that figure correct? Is that figure correct? I doubt it. I doubt Marimo's figure here. $915, $960. Yes, $915, $960. So then from there, we check whether we have any other non-current asset. The other non-current asset you may include here, include investment property, which we don't have, include investment, which we don't have. So meaning we need to proceed and we record the current asset. The current assets, we have a number of them. So in the trial balance, all assets have a debit balance. So below plant and equipment down there, I can see we have the inventory at the end of the year. The inventory which we record here is the closing. How much is that? 324,500. Below that, I can also see we have the trade receivables. Which is 469,700. And then down there, what we have are expenses. It basically means that in our case, we don't have any other item of current asset. So what we do is we proceed and we get the total assets. The total assets, we take the non-current asset plus current. And I'm getting 2160. Is this correct? 2160 Huh? Yes. Okay, I'm given by Helen 1710. Okay, yes. My figure is automatically long. So this one will give us 1710. One what? 160. So then from there we proceed and record now the items of equity. So for items of equity, that one we have those figures here. So it's just a matter of transferring them to our statement of financial position, equity. So what we record at the equity is the share capital and reserves. So we record this. So we have ordinary share capital. Ordinary share capital, this one is 672,000. Then we have the share premium. Share premium, this one, 48,000. So below that, we have the retained earnings. The retained earnings, the balance at the end is 450, 800, and then we have the revaluation reserve. The revaluation reserve, and basically the revaluation reserve is how much? 35,000. So that will give us now the total equity. The total equity is this one, which is 12,05,800. 12,800. Sorry, that is 12,05,800. And I think in our case, we are done with equity. So we need to wind up by recording now the liabilities. By recording the liabilities. So for the liabilities, we classify them into two: the non-current liabilities and current liabilities. Now, for a company, the non-current liabilities may take the form of a bank loan or debentures. So if you check on this particular question here, we don't have debentures, we don't have bank loan. So meaning that this company didn't have any non-current liability. Okay, there is something we need to include here, because other than bank loan or debentures, this company had a deferred tax. Remember this deferred tax. This deferred tax is basically a tax to be paid by the company in the future. A deferred tax, that one is recognized here as a non-current liability. And basically what we bring here is the deferred tax at the end. This one, 87,600. Yes. So then finally, we record the current liabilities. We record the current liabilities. Current liabilities, these are liabilities payable within 1 year. So liabilities in the trial balance, they have a credit balance. So we check the items on the credit side of the trial balance. Up there, I can see share capital, share premium, retained earnings. Those are items of equity. And then down there, I can see accumulated depreciations. Are those items of liabilities? No. Then down there, you can see we have bank overdraft. The bank overdraft, this is a current liability, and the bank overdraft is 43,100. Then below that, I can see we have a deferred tax, which you have dealt with. And then below that, we have trade payables. So the trade payables is an amount of 259,860. And then below that, we have current tax, which you have already dealt with. And then revenue, which is not a liability. So I think we are done with that. Maybe you can check here. Do we have any other current liability to be captured there? Yes, I think in this note, in relation to note number 3, we have the estimated tax liability. How much tax was our company supposed to pay during the current year? This one. The estimated tax liability the company was supposed to pay during the current year before adjusting that with over provision or other provision from the previous year. Our company was supposed to pay a tax of this. So that one, because it was not yet paid, and that is where it is part of the additional information, we also recognize it here as a liability, as a current liability. This tax will have to be paid within the next 1 year. And I think in our case, we are done. So what we need to do is we get the total equity and liabilities. The total equity and liabilities. So get the total equity and liabilities here. Get the total equity and liabilities. The total equity and liabilities. The total equity and liabilities. Total equity and liabilities. So you add all this, all that, it will give us a total of what I'm told by Zipporah, it will give us the same value, 17, 10, 1 what? 17, 10, 1, 60. 17, 10, 1, 60. Yes, I hope the rest are getting the same. That is, yes. Are you getting the same value? Are you getting the same value? Are you getting the same value? The same value, is that what you're getting? Yes. So that is confirmed. So basically that is it. That's what was required as far as that question is concerned. So, and remember you say that this is a very important topic, because if you go through the past papers, you'll be able to see there is a question almost in each and every sitting coming from this topic. So maybe we stop for at that point for today. I'll give you an assignment. You attempt this particular question. We will see whether once we meet in our next class, whether we will be in a position to do at least 2 questions on this. At least 2 questions, so that we wind up with this topic. I want you to attempt this question for August 2023, question number 5. You attempt this one. Once we meet in our next class, we will be able to see whether we can be able to do this one plus another question. That's yes. So let's stop at that particular point. We continue from there in our next class, which will be on Saturday. So have a good night. See you on Saturday.